Welcome everybody. It is noon, so I want to get us started on time. Just wanted to welcome everybody for joining us for this lunchtime webinar. Feel free to grab your lunch. You are muted and no camera, so eat away as we go through the presentation today. Again, today's topic is Introduction to Cost Segregation and the related tax benefits. Whether you're purchasing or renovating an existing building or constructing a new building, you should consider a cost segregation to maximize the tax benefits available to you. John and Mike today will be talking about the tax savings that might assist you in financing the construction project and or improve the cash for other initiatives and liabilities. I'm Carolyn Powell. I'm the Director of Development here at Tronconi, Segregating Associates, and I'm going to be your host today. Just a couple things before we get started, just to point out, on the right-hand side of your screen should be a toolbar. You can put questions in there. We'll answer those throughout the presentation, and at the end, we will certainly take questions, so you can put those in there. Like I mentioned, there is a copy of the slides if you want to pull those out and make notes, and also a full overview of our experts and their background. After today's presentation, you receive an email from the webinar asking for feedback, letting us know if you need anything and if this was helpful to you, and if you would like to set up a one-on-one call with John or Mike. So that'll be coming to you, and then also this afternoon, I'll personally send you an email, again with a copy of the slides and the recording in case you missed anything. So just take a look for those. So without further ado, we're going to get started. Again, Tronconi, Segregating Associates is a certified public accounting and business consulting firm. John Callahan is a CPA and partner with Tronconi, Segregating Associates with over 20 years experience in public accounting. He has a broad range of industries that he works in. Those include auto dealers, manufacturers, distributors, and real estate entity. Mike Zioli is also a CPA and a manager here at the firm with over 9 years of experience in public accounting. Industries that he works in is manufacturing, wholesale and retail, construction, healthcare, real estate, various service industries, and high net worth individuals. So I'm going to hand this over to John to get us started today.
Thank you, Carolyn, and welcome everybody, and thank you for taking time out of your busy day to tune into our webinar. I'm just going to take a few minutes to briefly go over the agenda and talk about the key takeaways that you should be getting at the end of this webinar. Essentially, we're going to start off by explaining, what a cost segregation is and the related tax benefits. We're going to identify tax issues that should be considered in conjunction with the cost segregation study. Now, in general, cost segregations provide benefits due to the acceleration of depreciation, which lowers your tax liability. So in general, it's a benefit. However, there may be times when this benefit may not be immediately realized. So you have to consider, and weigh the benefits and the negatives. We're going to identify the most common qualifying assets that can be broken out as part of a cost segregation study. We're going to discuss bonus depreciation and the Section 179 expensing election. These are the two most aggressive forms or methods of depreciation available to us now. We're going to briefly talk about some estate considerations, and follow up with a little discussion on the tangible property regulations, because as you will see that the tangible property regulations really go hand in hand and really should be considered first before even thinking about a cost segregation. So with that said, I'm going to turn it over to Mike, who's going to start off with an overview of cost segregations.
Thanks, John. Good afternoon, everyone. So I'm just going to touch on basic overview of the study. So what is a cost seg study? In basic terms, they're used to maximize the return on investment of a construction project. And this is achieved by reallocating costs from traditional 39-year property into asset classes with shorter recovery periods, thus increasing initial cash flow through accelerated depreciation deductions. So also it can be used to establish a unit of property under the tangible property regs, which John will go into further detail on later in the presentation. So when would you consider a study? So a cost-seg study is most advantageous after new construction of a commercial or residential dwelling. However, it can also be considered upon acquisition of a property for remodel projects and expansions of an existing building. So I want to touch on a illustrative example of new construction of a commercial office building. We will assume for this example that it was in service in 2022, so 100% bonus depreciation will apply. So we have $10 million project, commercial office space. Without a cost seg study, you're looking at depreciation over 39 years. With a cost segregation study, with a 25% reallocation to asset classes with shorter useful lives, we're able to increase the first year allowable deduction by a little over $2.4 million. So this equates to a net present value benefit of over $500,000 over the span of the 39-year period in which the building would be depreciated without the study.
And I'd just like to comment on that previous slide because it really should be noted that you don't have to purchase or build a brand new building for a cost segregation to be applicable. Any remodeling or any expansion to a building, those we can do a cost segregation for and try to achieve the tax benefits, maybe on a smaller scale, but even if the project, the remodel, expansion is only $1 million, you could still find a decent amount of accelerated depreciation at that level as well.
Thanks, John. So now I'm going to cover some of the eligible property types for a study. Now you can see here the reallocation percentages are relatively similar, aside from a select few. You can see restaurants, manufacturing facilities, grocery stores, and auto dealers. You can see a higher level of reallocation there, mainly due to the ability to reallocate certain property that by itself would be considered 39-year real property. However, you might have certain pieces of the building that are essential part of specific equipment. So, and I'll touch on that, as we go on here in the tangible personal property section. But to give a good example of this, for a restaurant, you might have special electrical that's devoted directly to ovens, dishwashers, et cetera, that you can reallocate from the 39-year property into 5 or 7 year tangible personal property, thus reducing recovery period, allowing for accelerated depreciation.
Yeah, the nature of the operations in that building has a lot to do with the amount of property you can reallocate from 39 years to 5 years or 7 years. Again, the manufacturing facilities is a big one. It's a big winner, along with auto dealers. The type of equipment they use in those facilities, really heavy metal stamping machines, other printing presses may need some reinforced concrete, which typically is part of the foundation, typically 39 years. However, if it's put into the building because it's needed to support the weight of those pieces of equipment, it can be a 7-year property. So manufacturing facilities is really the big one, and auto dealerships too, with their service departments and things of that nature, specialty lighting, as Mike had said.
Okay, so some of the tax considerations revolving around a cost seg study. As John had noted, bonus and/or Section 179 depreciation will apply to these costs that we're reallocating, which in turn will magnify the benefits. Unused tax deductions will carry forward indefinitely to future tax years. Depreciation recapture will apply to tangible personal property in the year of sale. John will get into more detail on this. Section 1031, like-kind exchange rules, that they should be considered with a cost seg study. There can still be some benefits. However, bonus depreciation would only apply to the excess basis in the new property. And then lastly, passive activity rules, that can be a major issue with certain real estate investors if they don't reach a certain status of real estate professional. So that's another important topic that John will get into further in the presentation. Some other tax planning considerations. These are a widely used tax planning tool for real estate professionals and investors. Studies would typically be performed in the year the construction is completed or when a property is acquired. However, those aren't your only options. You are able to go back and claim deductions that were previously missed by filing forms 3115 and making a section 481A adjustment on your tax return to basically change your method of depreciation in the past and change it to a more preferential method allowable through the code.
Yeah, and that's something that we've done a lot of here in our firm. When, in general, when we take on a new client, we always take a look at their prior returns to see how things were done in the past and if there's things that we can do differently. And essentially, we've done this a cost segregation on property that, let's say, was placed in service 5 or 10 years ago. And what we do is we do the cost segregation. We determine how much tax depreciation should have been taken from the time the building was placed in service to the beginning of the current year that we're in. And we compare that with what depreciation was historically taken. And usually you end up with a higher tax depreciation number with the results of the cost segregation. So that the difference between those two numbers is what Mike said is a 481A adjustment. And again, that is a deduction that can be taken on the current year's tax return. So it could be very beneficial to the taxpayer.
Okay, so now we'll get into the various types of qualifying assets that will be a part of a cost segregation study. So the first category and most advantageous from a tax standpoint would be Section 1245, tangible personal property. So you'll see here you've got your standard equipment, furnitures and fixtures, appliances, but then you have some other items here that are more unique in nature that you wouldn't, typically see just via a Google search for tangible personal property. You've got decorative lighting, for example. Now what this could be is, lighting that's not integral to the functionality of the building, meaning this lighting doesn't necessarily light up walkways or hallways or the exterior of the building, but they're more decorative in nature. And it's trying to accent something within the building. That would be an example of lighting that can be accelerated and treated as a 5 or 7 year asset. Decorative millwork, same type of idea here, and you can see in the photograph those wood trim beams, which I believe are holding the pots and pans. That would be a perfect example decorative millwork within the kitchen there that can be accelerated. Removable flooring. So good examples of this would be luxury vinyl tile, flooring that's not cemented to the floor like a ceramic tile, something that's easily removable, that would be allowed to be taken over a shorter recovery period. And as I previously mentioned, also on here, you know, with a manufacturing facility, for example, the reinforced concrete. So if you've got a heavy piece of machinery, you're likely going to need special reinforced flooring underneath within the concrete. So that portion of the concrete flooring within a manufacturing facility would be allowed to be accelerated along with the recovery period of the specific piece of manufacturing equipment. Along with that, you know, the electrical wiring, anything else as part of the general building envelope that's directly related to that piece of equipment can be accelerated, you know, to match the recovery period of that specific piece of equipment. And that would be the case for, you know, other building types, restaurants. You've got auto dealers. You've got the car lifts. You've got special electrical, special concrete that would go in directly with that asset. So the next category that I will touch on are land improvements. So land improvements consist of site preparation and site improvements. So in simplistic terms, these are all your improvements made to the surrounding area of the building on the exterior. So some examples would be your parking lots, your sidewalks, roads, drainage facilities, septic systems, sewers, fences, decorative landscaping, swimming pools, to name a few. We've also got freestanding light poles within a parking lot. All of these types of expenditures would be accelerated through a 15-year recovery period. So lastly, as part of the construction project, you're going to have your soft costs. And soft costs, to name a few examples, you know, you'd have your architect fees, your engineering fees, your building permits, your general conditions, legal and accounting fees, project management costs. Basically, all the costs that aren't directly related to a specific building component or a specific piece of tangible personal property, but they are still costs of the overall project. So all of these costs would be allocated to direct costs on a pro rata basis.
So once we go through and perform our cost segregation, again, we're taking let's call it a $5 million building that typically would be depreciated over 39 years. We're identifying all these different classes of property that we could break out to 5, 7, and 15 year property. What do we do then? Well, the main deal here is to calculate the depreciation on those shorter lived assets and even 39-year assets to a certain degree to get the most beneficial depreciation deduction that you can. So bonus depreciation, as I mentioned earlier, is one of the more aggressive methods of depreciation. And bonus depreciation really has been around for almost 20 years. I think it came out in 2002. And essentially what bonus depreciation is it allows you to take a percentage of the cost of that asset and just write it off. Okay, normal depreciation rules, just for a little background, if you would have a maker's modified accelerated cost recovery system, which is what most people use if they're not using bonus or Section 179. They take it over percentages over a year. So maybe 20% in the first year, and then 20%, and then another maybe 15% in the following years, depending on what life you have. Bonus depreciation, at least in 2017 through 22, you were allowed to take 100% write-off of that asset, regardless of how much it cost, regardless of how many assets you placed in service. And as a matter of fact, bonus depreciation is a requirement. We do have some clients that, for tax planning purposes, don't want to accelerate all of this depreciation. So we can actually elect out of bonus depreciation. However, with cost segregations, most of our clients are looking for the biggest tax deduction to lower their taxes in the year that they constructed or purchased a building. So for the most part, what we do is we take bonus depreciation on most of the 5, 7, and 15-year assets. And as I said, for 2022, that deduction was as high as 100%. Now, since the Tax Cuts and Jobs Act came out in 2018, there's a phase out of that limitation. So starting in 2023, there is going to be only an 80% deduction, and that's going to phase all the way down to 0% after 2026. And again, that depends on if there's any future action taken in Congress. This has been such a popular deduction that I can only imagine that it's going to be extended or come out in a different manner at some point. What goes hand in hand with bonus depreciation is qualified improvement property. Now, this is a concept that also has been around since the early 2000s, and it's been called a bunch of different things. There was qualified leasehold improvements, there was qualified retail property, there was qualified restaurant property. But with the Tax Cuts and Jobs Act, what they did is they essentially consolidated these other 3 types of properties and called it qualified improvement property. And this qualified improvement property is subject to bonus depreciation. So what is qualified improvement property? It's really any interior improvement made to a non-residential building after the building was first placed in service, by any taxpayer, by the way. And that's important to note because they are improvements. It's not construction. So a newly constructed building that was never occupied or placed in service by any taxpayer, that really is not qualified improvement property. These improvements must not be structural in any nature. They must not be an enlargement of the building. And also they cannot be elevators or escalators. So we have a really good example of this. Mike and I are working on a cost segregation for a client, and this client actually purchased land and a building on top of that land, and their intentions were to expand the building, put in some additional outdoor seating facilities. They were doing a banquet facility, a restaurant, and a brew house. Okay, so any of that new construction does not qualify for qualified improvement property. However, the existing building that was on the property, they are renovating that, and it's going to be a very nice facility. So any of those improvements made to that existing building, we're going to take a look at separately, and they're going to be 80% deducted in the first year. Next slide, Section 179 expensing. This is another very popular deduction, and that's been around since I think the late 1950s, and the total deduction back then was about $25,000. And essentially what Section 179 expensing election allows you to do is it allows you to deduct a certain portion of an asset. You could write off the entire asset, or you could write off a small percentage of that asset. And in 2023, the current deduction is capped at $1,160,000. Now, there is a purchase limitation here. Let's keep in mind that Section 179 is really a small business expensing election. So what the IRS has done is it says if you know you're too big of a company, you don't qualify for this. This is for the little guy, so to speak. But that purchase limitation is almost $3 million. It's $2,890,000. So it does benefit some of our medium-sized clients as well. But essentially, once you start putting assets in service that exceed that purchase limitation of $2,890,000, you lose dollar for dollar the ability to take Section 179 depreciation. So that depreciation limitation of $1,160,000 ends up could easily go down to zero. You know, once you are over $4 million of qualifying assets. So similar to qualified improvement properties, which are eligible for bonus depreciation, there are qualified real property, which is eligible for Section 179 depreciation. And qualified, real property includes anything specific in the code: your roofs, your HVAC systems, your fire protection systems, your security systems. And again, just like the qualified improvement property, these improvements must be made after the building was first placed in service by any taxpayer. And keep in mind that Section 179 and the bonus depreciation on qualified improvement properties, they are different, right? Because bonus depreciation would only qualify for the type of property that's defined in the code. Section 179 expensing for qualified real property only applies to roofs, HVAC systems, fire protection, etc. One thing to note here too is with the bonus depreciation, that is not, bonus depreciation is not available for New York State. So it's important to keep that in mind. If you're looking for a big federal tax deduction, you may get that, but for New York, it may not be as lucrative of a benefit for you. Also, that's just not for New York too. There's a lot of other states out there that only allow a certain percentage of bonus or Section 179. So Mike alluded to a few issues with the cost segregation, and so did I in the agenda. We have to balance the positives and the negatives, so to speak. And one of the negative consequences is with the passive activity rules. And it's important to understand that real estate in general is a passive activity, okay? And passive activity loss rules generally limit the amount of active trade or business income that can be offset by passive losses. So for example, if we have a wealthy client that has a $1 million W-2 and pretty much nothing else on his tax return, so that person may complain about all the taxes that they're paying. So they may decide to go out and buy a $10 million building and decide to write off everything do a cost segregation and write off as much as they can on their building to offset their wages. Well, that's not going to be allowed, okay? The wages are active income, or it's earned income from an active trade or business, and the real estate loss that he's going to have is going to be passive. Now, one thing to keep in mind is that passive losses, as I believe Mike mentioned earlier, if they're not deducted in the current year, they will carry forward indefinitely. They are tracked on a Form 8582 on the individual's income tax return. So they will be available to offset passive income in future years, okay? And actually, we have a client that was in a similar situation to my last example there. He had a very large W-2. He had a lot of pass-through income from an active business. But he built a $4 million building that he rented to a bunch of doctor practices. And in the first year, we did a cost segregation. I believe we got over $1 million of depreciation, or actually over $1 million of losses that he wasn't able to use against his other active income. But that is setting up, like a deduction to offset income in the future. So quite honestly, for the next 10, 20 years, whatever it may be, he's not going to be paying tax on any of his passive income. Now, although passive activity rules may be an issue, there are solutions to that. One of the most popular solutions is the grouping election. So section 469 of the Internal Revenue Code allows a taxpayer to make a grouping election to combine active trade or businesses with passive trades or business. And essentially what it's called is considered one economic unit. And we see this a lot in our client base. We have a client that owns 100% of a manufacturing facility or 100% of an auto dealership, okay? And for legal purposes, they want to own the property in a separate LLC, let's call it, okay, which they own 100% of, okay? To make a grouping election, you do have to meet certain requirements that are listed in the third bullet point below on this slide. But essentially, the main ones are, common control, common ownership, interdependencies between the activities, and similarities of the operation. So as you can see, if you have an auto dealer on one hand, and you have the real estate in the other hand, and you're renting the real estate to the auto dealer, and the same owner owns 100% of both of those entities, that absolutely could qualify as one economic unit. Essentially, think of, instead of setting up two entities, the owner has a dealership and he had the dealership entity purchase the real estate. So what happens if you're one economic unit, those passive losses from that rental activity, which owns the dealership property, can be used to offset any income from the dealership. And another, a second solution to the problem, passive activity rules, is becoming a real estate professional. This is a little bit harder of with more requirements to satisfy. Essentially, 50% of your time needs to be in the real estate business, and you have to spend more than 750 hours in the activity. So, we've tried to do this with a lot of our clients. Let's say it's an auto dealer, there's certain, if he wants to be a real estate professional, he really is having a hard time doing it because he's an auto dealer, right? He's managing the auto dealership, and he's spending more time in that than being a real estate professional. So that's where these two rules for real estate professionals need to be taken a look at. Another issue is depreciation capture. And upon the sale of the property, a taxpayer is required to capture depreciation on the section 1245 property that it has depreciated. Essentially, it's, you got to just, if you in year one you buy a piece of a large building and you depreciate it $1 million or $2 million, when you sell that property, the gain is going to be very high because you've accelerated all this depreciation. So if you're buying a building and doing a cost segregation in year one, and you're planning on selling it in year two, that may not be the best answer for you, because yes, you'll get the benefit in year one, but then you're going to pay the piper in year two. You're going to pay the IRS back for that tax benefit. So it may not necessarily, the benefit that you receive in that year one, may not be as great as you think it is, especially when you're considering paying a firm to do a cost segregation. The time value of money may just not be there. However, if you're planning on holding this building for, I don't know, 10 years, 5 years or 10 years or something like that, it may be worth it for you. Like, even if you get $1 million of accelerated depreciation, if that's a complete tax savings at 45%, you're saving $450,000, which you can invest back into your business, or you could invest in other activities, and you really don't have to pay that tax back until you sell the property, right? If that's 10 years from today, you're going to have essentially a 10-year interest-free loan. There are ways to get around the issue of depreciation recapture. And essentially that kind of goes hand in hand with estate planning. You know, if you're gonna hold on to it for 1 year and sell it, not a good idea. If you're gonna hold on to it for maybe 10 years, better idea. But if you're gonna hold on to this property until you die, it maybe even be you know, the best idea ever, so to speak. Because essentially, when somebody dies, okay, they value their estate based on the fair market value of the property, okay? And as a decedent, your estate is going to pay an estate tax if the value of your estate is greater than the lifetime exclusion, okay? If it's less than the lifetime exclusion, you're not going to pay any tax on the value of your estate. And since you're not selling the building, you're passing it on to your beneficiaries, you're not going to have that recapture tax that we were talking about. And in addition to that, when your beneficiaries take over the property, they're going to get a step up in basis, okay? At least under current rules right now, they're going to get a step up in basis to fair market value. So they'll be able to start depreciating it then, and they could do the cost segregation, and then they could start to benefit greatly. So that is just one thing to keep in mind with trying to get around the depreciation and recapture issues. The next topic I really want to talk about is the tangible property regulations. And, you know, these tangible property regulations were effective January 1st, 2014. However, they've really been around a little bit longer than that. Yeah, maybe even 4 years. I remember back in the time they were released, and they were recalled, and they were temporary, and then they were proposed, and so on and so forth. But then they were finally put into place in 2014. And these regulations are really taxpayer friendly, okay? They've really helped taxpayers identify, you know, what a unit of property is, you know, when to capitalize items, how to treat amounts paid to acquire or improve property. They also had disposition regulations, certain expensing elections. There were small business elections for smaller businesses as well. And essentially, you know, the most applicable part to our conversation today is really about capitalizing versus repairing. Because when we started off this webinar, we were talking about doing a cost segregation. Well, cost segregation is done on an asset, a building, let's say, that you have capitalized and put on your balance sheet. These tangible property regulations are going to help you determine if the money you have spent is really a repair or a capitalizable item, okay? And the key words to remember here are betterment, adaptation, or restoration. And the regulations really spell out what is a betterment, what is an adaptation, and what's a restoration. And a betterment is really you know, you're making something bigger, better, more efficient, stronger, you know, really significantly better, a betterment. An adaptation is something where you take a retail facility and you turn it into a wholesale facility, or you take a movie theater and turn it into a whatever, a clothing store, things of that nature. Those are things that adapt the building to a new purpose, which absolutely need to be capitalized. And restoration is something, you know, taking something back from the dead and bringing it back to life. You think of you're restoring an old car, you know, things of that nature. So if it is a betterment, an adaptation, or a restoration, those costs need to be capitalized. If not, that you can actually expense them. And, you know, quite honestly, it's amazing about, you know, for tax purposes, how much you could actually expense. And these are examples straight from the regulations. One of my favorite examples is replacing a rubber membrane on the roof. So your roof is leaking, and the problem is the membrane on your flat roof is broken in a couple of spots here. Well, a rubber membrane, even though it may cost $200,000, $300,000, for tax purposes, that's really something that could be expensed. Same thing with window replacements or HV replacements. If you have 10 HV replacements on the top of your building, you know, and you only replace 2 or 3 of them, they could be expensed as well. So expensing is obviously better than capitalizing, because you may run into the issue of limitations on Section 179. You may, if you're taking bonus depreciation, you may run into New York State limitations in that area. Next slide is demolition consideration. So it's really important for you to understand that demolition in general is not a good thing. You know, the prior example of our client, if they bought land with a building on it and they just bulldozed the building, okay, they didn't use the building, the cost basis of that building is going to be allocated to the value of the land, which is a bad answer. You know, so let's just say you spend $2 million on a building in a parcel of land, and if you were to break it out, maybe it'd be $1 million for the land and $1 million for the building. Well, if you immediately demolish that building, your land's going to be worth $2 million now, and it's not going to be able, you're not going to be able to depreciate that. So that's a bad answer. So what you might want to consider doing is actually occupying the building, placing it in service, see if it works for you, do a cost segregation, accelerate the depreciation deductions, then at a later date, you know, of course, you got to space it out a little bit. Go ahead and demolish the building, and you'll have better cost allocations to the tangible property or the land improvements or things of that nature, which you would have taken a deduction for in year 1, and less costs will be allocated to land. Okay, so partial dispositions. You know, this was something that was really big with the tangible property regulations when they came out, and we actually helped a lot of clients, you know, with this. But a partial asset disposition allows a taxpayer to write off the remaining depreciable basis of items removed from a building during a renovation project. Okay, so let's just say you're starting up a renovation. And you have to take a bunch of stuff out in order to put the new stuff in. That stuff is going to be, you're going to be able to dispose of that and take a, you know, a tax deduction. And we, you know, one of the biggest examples I saw this was a few years back. One of our auto dealer clients had a renovation. It's probably in the 2019 or 18, somewhere in there. But their manufacturer actually requires a lot of renovations. So in 2005, they may have redone the showroom. In 2010, they may have redone the service room. In 2015, they may have done the client waiting room. And then in 2020, let's say, they had to redo everything. Okay, so this was a situation where we actually went back and did a cost segregation on each one of those renovations, okay, in 2005 and 2010 and 2015. We had to pull the blueprints and so on and so forth, but we were able to not only identify, you know, cost of the current renovation, we did a cost segregation on that, so we were able to accelerate those benefits by capitalizing in bonus or Section 179, but we were also able to dispose of some of the old renovations. So that's a big thing too, and that's, you know, very important when we talk about cost segregations. So the next 2 slides, I know we're running out of time here, we're getting late, are just some flow charts for you to take a look at to determine if something should be expensed or capitalized. The second one is really, you know, your improvements, flow charts. Is it a betterment? Is it a restoration? Is it adaptation? You know, obviously, anytime that you're doing work on your building, let's say, you really should consult with your accountant to see if, hey, is this something that I should capitalize? And if so, is it great enough for us to do a cost segregation? So just some frequently asked questions here to some final up things here is, you know, what is your typical time frame of a cost segregation studies? and I'm sure Mike will agree with me, but they can vary, but in general, it's 30 to 60 days, depending on the complexity, depending on the availability of the documents that we need, depending on how much help we have from, the taxpayer. How much does a cost segregation cost? Again, that's usually in the range of $10,000 to $15,000. So that's why I was saying it's important for you to understand, if I'm paying somebody $15,000 for a cost segregation today, is the depreciation benefit and the time value of money great enough for me? And if I say, geez, boy, I can get you a tax deduction of $500,000 this year, it may be worth it, I'm sorry, not a tax deduction or a tax savings, let's say, of $500,000. There's plenty of money in that $500,000 to pay for a cost segregation. But again, it does depend on the square footage. It also depends on a few other things. And then the final bullet point there is really how much or how big of a project must I have in order for a cost segregation to be worthwhile. And in general, I think we're, $750 to $1 million is a good number of an investment to take a look at a cost segregation. And even if a cost segregation is not beneficial to you, again, the TPR analysis is really something that's important as well. So if you have a small project that you don't think you want to spend $15,000 on for a full cost segregation, Mike and I and our team could do a tangible property regulation study for you and help you just identify costs. Is this something that needs to be capitalized in the first place? Do we have a position to go ahead and expense these items rather than capitalizing them? So,
All right.
that's all I've got. Mike, any final comments or any questions in the queue I should ask first?
Yeah, just a reminder to everybody, there is the question section in your toolbar over there. Throw some questions out to guys if you have anything that you want to ask on. I do want to give also just a comment to the various incentive programs through the county and the state. So much of this is tied together on those big expansion projects and new construction that there could be some dollars out there through those agencies. We do have experts in-house that can answer those questions and connect you with the right offices to potentially find dollars there also. But again, put any questions in there. Mike, I don't know if you had anything you just wanted to add to John's slides or any comments?
Yeah, I did just want to touch on the last slide there as far as our services and fees are concerned. So that fee structure there of $10,000 to $15,000 would be for a full study, full report, basically showing all our analytical procedures, et cetera. We do also offer a light version, if you will, which would be more of a simple assignment of lives to still assist you with your reallocating costs to shorter recovery periods. Maybe it's a smaller project and it's not worth the full cost. So we do offer a light service on that as well.
Yeah. And again, you also don't have to be a client either. If you have a guy that does your tax return and he's been doing your audit or reviewed financial statements, your bookkeeping, your tax return, this is just one of those special services that Mike and I and our team provide our clients, but also other clients. And if you just want us to help you with that, and you could take a report to your accountant, and they can prepare your tax return based on the cost segregation, then that's fine with us too.
We do have one question that came in from Mark. Can we prepare a pro forma to assist with cash flow projections for a project?
I guess at a high level, Mike, would you agree? I don't know if we could give a full analysis of the cash flow, but with certain assumptions, we probably could tell you, based on these assumptions, if you, let's say you spend $5 million on a building, based on the assumption that we, again, we would have to agree with these assumptions with you, but we would, have a good idea, generally a good idea, a certain number of assets would fall into 15-year property, 5 and 7-year property. We could absolutely calculate the depreciation on those assets and the class lives and tell you how much your depreciation deduction will be for the next 39 years, right?
Yeah. Also, we factor in the type of property, the interest rate on financing would come into play there, for cash flow purposes. So yeah, that's definitely something that we could do, obviously based on a number of assumptions.
Great. Well, thank you. Just want to remind everybody that you will be getting a post-webinar survey, just asking if you could give us some feedback, if you have any additional questions for our experts, or if you would like to meet with one of our experts one-on-one, you can do that in there. That should be coming to you as soon as this finishes. And then, like I said, this afternoon, I will send an email to everybody with a copy of the slides for you again, and a link to the recorded version if you want to rewatch it or share it with somebody else in your office. Our next webinars coming up will be June 21st on captive insurance and July 18th on filing sales and use tax returns. So I want to thank everybody for joining us today. Thank you, John and Mike, for being our experts today. And we look forward to helping you with any of the projects that you're working on. Have a good day, everyone.
Thank you, everybody.